$830 billion. That's the amount by which Chinese real estate sales have dropped since 2021. Back then, the total value of real estate that was sold in China mounted to about 17.5 trillion yuan. This came down to around 12 trillion yuan in 2023. It's the largest decline of the last decade. In US dollars, that's about an $830 billion drop in sales. That's larger than the GDP of Poland. Meanwhile, the value of the Chinese stock market has dropped by around 60% since its all-time high in 2021. This situation is much like the 2008 financial crisis in the United States. The US stock market also fell by 60% due to a real estate crisis. In hindsight, the 2008 crisis was a golden opportunity to buy cheap stocks. The question now is whether we're seeing a similar setup for Chinese stocks today, or is there more trouble ahead for China? One key similarity between the current Chinese market and the US market post-2008, it's how cheap Chinese stocks have become. The forward price-to-earnings ratio of the Chinese stock market is now under 10. US stocks also had a PE ratio just under 10 at the height of the financial crisis. Such low valuations are quite rare in recent history, with the average PE ratio over the last 20 years being above 15. If Chinese stock valuations were to reach a PE of 15, it would push Chinese stocks up by over 50%. Buying cheap stocks can definitely add an edge for investors. But low valuations can sometimes last for a long time, creating what is known as a value trap. This was true, for example, from 2011 to 2014. Chinese stock valuations stayed under 10 for 3 years. Stock valuations only rise when people have become more optimistic about them. This optimism makes the stocks more expensive. Today, there's a lot of pessimism for Chinese stocks. That's despite the fact that Chinese companies are now much more profitable. Profit margins have expanded significantly since last year. This is a big reversal from the period between 2021 and 2023. More profitable companies tend to be more expensive. So if this trend continues, it could eventually lead to higher valuations on Chinese stocks. When we look at the profitability of US corporations in 2008, they also had a sharp rebound at the end of the downturn. This was a great sign for US stocks, telling investors that the worst was likely in the rearview mirror. This is typical behavior. Economic slowdowns cause profit margins to get squeezed, which forces businesses to cut costs. Once the downturn is over, profit margins expand. That is what's happening with Chinese stocks today. So there are clear similarities between Chinese stocks today and the US stock market in 2009. They have cheap valuations and they are becoming more profitable. This has led to a bit of a bounce in the Chinese stock market since the start of the year. Although it doesn't look like much, the Shanghai Composite has finally managed to break above a downward trend line that it's been under since 2021. But China isn't quite out of the woods yet. Chinese real estate is still very much struggling, and when we look at the real estate index in China, it hasn't seen much of a recovery recently. Historically, Chinese stocks have never truly recovered without real estate getting better. It's a big question whether Chinese stocks can have a lot of runway here without the Chinese real estate market recovering. Chinese property prices are falling at the fastest rate since 2015. This is, of course, impacting consumer confidence in China. Property ownership is highly valued in China, so changes in real estate prices directly affect how people feel about finance. When people see their main asset losing value, it makes them anxious, and they become more cautious about spending. One survey of Chinese consumer confidence shows it is actually at the lowest level in the last 40 years. With such poor consumer confidence, Chinese consumers are unlikely to spend a lot, and so Chinese companies are unlikely to see a big increase in revenue. When we look at the revenues of Chinese stocks, they are in a strong downtrend. They've recently reached the lowest level in over 20 years. So we have a situation where Chinese companies have cut costs and have higher profit margins, but they're not seeing an increase in revenues because of the deterioration of the Chinese economy. Now the question is, do we have any signs that the Chinese economy could actually recover here, which could lead to higher confidence, higher spending, and higher revenues? One encouraging signal is that the Chinese government recently announced they would aim to support the weakening property market. Government measures and fiscal injections could restore confidence in the real estate sector and stabilize the market. The Chinese credit impulse, however, isn't showing a clear sign of recovery. This is different from previous episodes of recoveries. The Chinese credit impulse is a major driver of the Chinese economy. The index measures the change in new credit as a percent of GDP. It is a leading indicator that helps predict economic activity and growth. When the credit impulse is positive, it suggests growing credit, which typically leads to higher economic activity and GDP growth. Historically, the credit impulse in China leads the Chinese housing market. Today, the credit impulse has been hovering around zero for the last couple of years, not suggesting that we are about to see a large recovery. This indicates that not enough new credit is being issued to stimulate the economy. This could, of course, change if we were to see significant intervention from the Chinese authorities. When we look at the recent price action of Chinese stocks, we do see that they've made quite a nice move up recently, bouncing by over 30% and breaking above a key downtrend line. Prices have managed to clear two key moving averages that can act as a tough resistance during downtrends like in 2022 and 2015. Seeing prices clear these moving averages is a great first sign. For Chinese stocks to really show signs of turning around, prices should hold above these moving averages and ideally bounce off them to begin a new uptrend, similarly to what happened here in 2016. Failure to stay above these moving averages could suggest that the vicious downtrend in Chinese stocks is not over yet, though, and that they could be at risk of additional downside over the coming months. There are two main ways to gain exposure to the Chinese economy. These are the MSCI China Index, which you can trade through the ETF MCHI, and the China A50 Index. You can access both of them on Capital.com.